Hey, what's happening? Trader Tim here from EminiMind. I want to talk a little bit about volatility and some things you can do to kind of adjust your trading when volatility kicks up, and both intraday and then from a kind of a hedging perspective. One of the nice things about buying puts versus buying calls on the subject of hedging is that when you buy puts as the position goes your way, meaning if if the market goes down, so let's say we're buying puts on the SPY, and if if the market sells off, you're going to get a rise in volatility, and that's going to kick up the value of the option with the implied volatility, regardless if the position is actually going in your favor, like going down. So when you buy calls, conversely, if you're buying calls when the market's down, volatility is typically up. So you're going to pay more for the calls. And then as the market goes up, the implied volatility goes down. So yes, your position will go up, but it doesn't go up by as much as a put goes in your favor if the market's going down. So for that reason, I prefer to buy puts rather than buying calls. And we've had a big drop in the VIX in the last couple of days here. We'll pull up the VIX here. That was our initial spike, and you can see most of the day spent in the 30s on that initial drop from the August 5th, and then we've come back down to kind of the mid-20s. Looking at those calls right now for like August 16th or even August 23rd, they've come down a lot in price, but we're still kind of spendy. I like to get them closer to, you know, $3.50 to $4, and you can see just how far, even like August 16th, how far you'd have to go out of the money to get that price. With the bigger range and bigger price swings, it does mean you don't have to go so close to at the money. So like we're right about 532 is the 50%. We're trading at 530. So something like 525 is a little bit out of the money. We're still up, 470 in that range. That's getting to be okay. But it'd be nice if we get one more up day where we can kind of get those a bit cheaper. And then if the market rolls over, then you're going to have a big jump, and all of a sudden they're worth $15, $20 from your $3 or $4 initial buy. So switching gears to intraday, a couple things you can do, and we talked about this on Tuesday during the live trading session. You can cut your position in half and double your stop. That will keep your risk the same. So if you're looking at a candle, let's say that is now 5.25 points here, when that candle a week ago might have been 2.25 points, you can still take the same trades. You just need to account for the larger ranges, meaning larger stop sizes. It also means larger profit potential, but you don't want to just look at the profit side. You want to factor in the risk side. So if you're trading, any multiples of contracts, let's say you're trading 4 ES contracts, drop it down to 2, you can double your stop, double your profit target, you keep the same risk. If you're only trading 1 ES or 1 NQ, you could drop it down to 5 micros for the time being to keep your risk the same. But I would really encourage you to getting to that, at least 2 of the regular minis, whether it's NQ or YM or any of them ES. That's going to do you a lot of good to be able to scale out, and it's just it's a good spot to, like, a good target to get to. So if you're starting with the micros, it's okay. You don't really want to be trading 20 or 30 micros. You're better off going to 1 or 2 minis, but getting comfortable with multiple contracts, that is a good place to do it. And so if you do have to drop down to the micros when volatility kicks up, it's okay to keep trading. But you can also do something like the Top Step or Apex funding and go through their combines, get become a funded trader with that kind of prop firm model, and then have a lot more leverage, whether it's having a bigger capital account and trading 4 or 5 contracts, or having multiple accounts and just trading one contract and having it copy it to 10 or 15 or 20 contracts or 20 accounts. Then you get a lot more leverage, and you don't necessarily, a little 10-point move like today. Here there was a nice hammer that formed right at the 50%, and it tagged up on the 21 EMA. So I took that long above the hammer, and that one ran up. I put my stop below this inverted hammer, and that was a 10-point move right there. So even with one contract, 500, that's $500 on the ES, and you do that with 10 contracts if you're scaling across 10 accounts, or even if you just trade 4 contracts, all of a sudden that's a $2,000 trade, and you're you can keep your risk under control and have a really good reward to risk. So this candle is 4.25 points. So let's just call it 5-point stop just for simplicity, and a 10-point profit. That's a 2-to-1 reward to risk. So even though the ranges are bigger, you get the benefit of having bigger moves, bigger profit targets. So if you're going to double your stop, you want to also make sure you're doubling your profit targets, or having the expectation that, okay, instead of getting 4 or 5 points on some of these smaller trades, now a smaller trade might look like 8 or 10 points. And this was only a matter of 1, 2, 3, 4, 5, 6 bars. So you're talking a little over 5 minutes of a trade to go 10 points. So if you're trading the NQ, you're probably going to notice the trade ladder moves very, very quickly, and it can be a little bit difficult to manage sometimes. You're kind of hitting recenter a lot, and all of a sudden the price is kind of dropping off your trade ladder and moving fast. So you're probably, you can see a little more slippage in the higher volatility environments, but even in the last couple of days, things have slowed down a lot and become a lot more manageable. When it comes to like actually placing orders. And then the last thing to note is just that you see the biggest up moves in the context of a downtrend. So don't be surprised if we have some massive up days in the context of a larger sell-off, because you get these bounces, whether they're the start of a longer uptrend or just a dead cat bounce, meaning we just kind of bounce to the next 50% and then roll over. But you're going to see some big up days. So if you're looking to buy puts, don't let that completely scare you. You can take a look at the volume, and like over here, we can see on the daily chart, these last couple of days of bouncing has had lower volume. So probably get a rollover at some point. But if the Fed starts hinting at lowering rates, then you can end up in this kind of conundrum where the market starts to take that as a really good sign, that people will take money out of cash and savings and move it into stock investments that are, not, that are more appealing. Whereas if interest rates are really high and you can make 5% in a savings account, there's not really a need to put your money in the stock market and get a 3% dividend and then have the volatility risk. So if all of a sudden there's a hint of Fed lowering interest rates, now more money flows into the stock market, and what does it do? The stock market goes up. So we may end up just going on another tear into all-time highs in the next couple of months. So don't let that surprise you, but we'll probably see some higher volatility. And when I say high, mid-20s is not very high, but it's a lot higher than most folks are probably used to. If you started, I know a lot of people started trading in 2020, and as soon as we got past that little dip, right at the start of COVID, volatility just went down to nothing in the low teens, and it was just an upward tear right from there. But if you've been around longer, like I have, through 2008, the mid 2000s, we saw lots of volatility, in the 40s and 50s, even in like 2015, 2016, and then even into like 2018 and a little bit of the start of 19, but more so 2018, some bigger sell-offs, more volatility. And so it's nothing to really be scared about. A lot of times it's good for intraday trading. You just have to make sure that you're managing your risk so you're not getting into positions and being immediately stopped out, because now instead of moving 4 or 5 points in a matter of a minute or two, it's moving 4 or 5 points in 20 seconds or 30 seconds. So a lot of times on the first day that we get a big volatility bump or like a big major gap down that's kind of out of the norm, I will just sit on my hands that day and observe and just kind of take in and kind of get used to the new environment, and then come back in a couple days trading. But there's not really, it's not like the big sell-off volatility days are the days where I have a bunch of trades and make a bunch of money. It's typically the opposite. I sit on my hands. I'll use those days to like buy, add to my long-term positions on the big scary days where the media is saying the market's, the world's coming to an end and the stock market's going to zero. Those are the best days to buy, add to your long positions, and then the next time we come back up to all-time highs again, your account is 1.5 or 2 times bigger than it was, because you've been buying on the pullbacks and then reaping the benefits on the way up. And I would say most of you, if you check your account balance since the start of COVID, your net worth has more than likely doubled, if not more, if you have real estate. I know that's been my situation. So these big volatility environments or times when we get these sell-offs can be really good opportunities if you don't panic and stay level-headed. So hope you have a great weekend. If you have questions, you can drop them in the comments and I'll try to answer them there. Thanks. Have a good one.